Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel, all the comments and subscribers. I greatly appreciate it. This week up, Salesforce.com. Let's check out Salesforce. Let's figure out how much cash flow they make. Let's look at 9 years of historical information. We'll build a forecast. We'll say, what if we hold this stock for 10 years? How much cash is it going to generate? And if we bought it today, what can we earn by holding the stock? You ready? Let's get to work. Let's talk Salesforce.com. Behind me is their 10K. Their fiscal year is January 31st. So this is January 31st, 2021 and back 12 months. I'm filming this in December 2021. So there's another 10K coming out, their annual report coming out probably around March sometime by the time they get it all done. So look for that in the next couple coming months. But we're going to pull the most recent data here. We'll look at what the market has currently data available, and we're going to piece this together. But before we dive in, let's review the 5 key attributes that we use to value all of the securities in this channel. Number 1, top line revenue growth needs to be there. Earnings growth, we use EBITDA, enterprise level earnings. Free cash flow needs to be there, low debt, and a well-priced stock. Well-priced being, if I bought it today, held it for 10 years, do I beat the market? Is that IRR above or below 10%? And how much risk is there that the stock will underperform, that the earnings will underperform? What's that balance? If that happens, if that beats the market and the risk is low, that's a well-priced security. We're going to look at to buy it. Behind me is the 10K, actually the annual report, but the annual report's glossy up top, and then behind it is the 10K, which is the annual report filed with the SEC. Highly suggest you read it every year for every stock that you own. It'll keep your portfolio small because you have to physically read these things, and they have tons and tons of valuable information in here that's spelled out in black and white, not a fancy glossy presentation. Just look at this thing. This is just cold hard facts, as opposed to if I flip over to the Investor Day presentation, ta-da, much more glossy, right? Because this is a sales document to sell investors. This is a legal document that they have to file, and you want to be reading the legal document because they're going to tell you things in here that they're not telling you in the ta-da Salesforce. Let's go through the sales plan really quickly. As I go through this, you're going to see exactly how salesy it is. It's very colorful and animated. It makes you feel like you're really buying into something with the glossy pictures, and it's very nice. It's actually a wonderful presentation, but I'm just interested in the cold hard facts of what's the growth rate, what's the business, what's the cash flow. One slide here, they do talk about the growth rates of the markets that they're in, which is nice, and they're growing essentially a double digit over time, which is a good thing. The next one I want to look at is just the revenue performance. Historically, they give a very good long-term view, and they give you guidance of 50 million for top-line revenue. Here, operating margin is growing. That's going to essentially be EBITDA that we're looking for, and this means that EBITDA margin is growing. As they've been acquiring interesting companies, I like the Slack acquisition a lot. For them, actually, I think it's going to be a big deal. But I love to see margin growth over time. And what we always love, a free cash flow slide. Good job, guys. I love to see that. Free cash flow is growing in line with operating margin. That's excellent. It's positive the entire time. And they're saying, hey, we're going to make about $5.5 billion next year. Fantastic. So overall, I wanted to pull this out. Let's go to actually income statement, balance sheet, cash flow in the annual report now that we've looked at some high-level glossy numbers. All right, behind me is the balance sheet that's on their annual report. I'm on page 84, as you can see from the PDF. I highly encourage you to follow along. So as of January 31st, 24, let me pause here for a second and remind you, balance sheets are points in time. Income statement and cash flow statements are over time. So much like you always measure your checking account as a particular date, whereas income is measured over time. Let's just keep that in mind as we go through. This is as of January 31st, which is the end of the fiscal year. This is what they had. Cash, $6.2 billion of cash in their checking account. And on top of that, they had another $5.77 billion sitting in marketable securities. That is an amazing amount of jack. Over $11 billion just piled up because they don't literally know what to do with it. I love to see that. $21 billion, $22 billion of current assets. They've got some general assets here. Most of it's goodwill, right? That's going to be the premium that they're paying for these digital acquisitions. They're paying high market multiples for them, and they have been able to roll them into their network and produce results from that. So while we normally don't like to see high goodwill as a percentage of total assets, they seem to be able to make it work and certainly generate the cash flow. But moving on, debt, current liabilities, $17 billion, and total debt, $24 billion. Benjamin Graham would like this because you cut your current assets is basically equal to total liabilities. Certainly all the debt obligations, current assets are greater than the liabilities. So that's a phenomenal capital capital structure. There you go. And the risk of bankruptcy is very low. That's what us as equity owners buying at the very bottom of the capital stack, we want as few people in front of us and the assets as possible. And to have a company that you can put your money in with nobody in front of you that's growing like it's growing is a great start for an investment. All right, let's keep going. All right, after the balance sheet, we're going to look at the income statement. This income statement ending January 31st, the 12 months of income ending Jan 31. Total revenue, $21 billion. That's up from 17 to 21. Variable cost, their cost of the software to make it. Total cost of revenue, $4.4 billion. Gross profit, very, very strong, $15 billion on 21. And you've got just the general operating expenses, which is research and development, sales and marketing, general admin, and kind of some other settlements, one-time issues. Overall, they do make profit, kind of weekly. Operating income, $455 million. Now, that is very, very low from the $21 billion that they're generating. Kind of what's going on. How do they keep so little of it? You've got a lot of depreciation in there, which is basically baked into these numbers here. When they develop a piece of software, they capitalize it on the balance sheet and they expense it over time. So it's a non-cash cost. We'll cover that. Non-cash cost, but they get to expense it monthly. Also in here is share-based compensation. Those two combine to lower earnings to $455 million. Up from $295 million the year before. So they made $455 million in operating income. Right below this, you're going to see $2.2 billion. That is the gain on strategic investments. So that is a non-cash increase in the investment value that they had made previously. It's basically the year-over-year change in the value of an investment they made. It's not real earnings that's specific to them running their software, right? It's below what we call the operating line, below the line. It's an investment that they made in a business that grew, awesome, but it's not really part of their main business. So I don't want to include that when we're doing our EBITDA, because what we're trying to do is figure out what does the underlying business generate, not how did one particular investment that they made perform for that particular year. So earnings are kind of weak. Again, because of accounting changes that they're able to do. Let's see if that translates into cash itself. All right, here's our cash flow statement for Salesforce.com. We're going to begin with net income, $4 billion. And we're going to make adjustments for non-cash charges that they took on the business. And depreciation, $2.8 billion. That was expense. That's why operating income was only $455 million. They've got amortization of the cost capitalized to obtain revenue contracts. That's basically their sales and marketing material that's baked into their COGS number. $1 billion of expense that's not actual cash. They spent the cash many, many years ago. They put it on the balance sheet and they spread it out over time over the life of the product that they developed. Expenses related to stock plans, $2.1 billion. That's a lot of jack that they're paying out to stock plans. I want to note here that that's 2, that's 1, that's almost 3. That is $6 billion here of non-cash charges that they expensed, but really they generated cash because they didn't have to pay this in cash. So there's a big difference here between what they're showing in their P&L and what they're generating in cash. Last thing, gain on strategic investment. Remember that $2 billion of profit that boosted the net income? Well, that wasn't actually cash. It was a book adjustment, so they have to subtract that number because they didn't receive it in cash. The net result here is net result cash provided by operating activity, $4.8 billion. This is actually the money, the cash money that they generated by operating their business for the 12-month period of time, $4.8 billion. The cool part is it's up from 4.3 and up from 3.4 over this time. So that's very, very good. Then we look down to see kind of what do they have to put in their business. They got CAPEX, they've got stock, debt investment. They don't have too much debt, and so those sections are pretty clean. All right, so now that we've reviewed the income statement, balance sheet, and cash flow, let's drop that data into our economic model, look at the historical numbers, and figure out how do we want to forecast this business going forward. And the very first thing we're going to do is we're going to review revenue. So as of January 31 of each year, these are in millions USD for Salesforce.com. 2013, they had $3 billion of top line revenue, and that number has grown to $21 billion. That is a 27% annualized growth rate. Wow, that is lightning on fire. Good job, guys and girls, for growing that business. EBITDA, $130 million, has grown, 30 times. $3.3 billion is monster growth. If you look at that on an average basis, it's a 50% annualized growth rate. Whew. And what we saw earlier when I showed you the Investor Day presentation with margins growing up, well, that's exactly what this means. Here, if revenue is growing slower than earnings, that means margins are expanding. That's tying with what we saw in their Investor Day presentation. That's good for us. So that checks those boxes. All right, the next thing we need to do is make enterprise value for Salesforce.com. That's going to start with the debt line. $521 million of debt has grown to $2.6 billion. That's roughly 5 times growth rate of debt, which is a big growth rate. But it does look like earnings have grown faster than that, so I doubt that's going to be an issue. Excess cash, $120 million to $5.77 billion. The cash is stacking up as their margin grows. They're really not spending their money as fast as they're generating it. Market cap, $23 billion to $207 billion. Monster growth, 10x on the market value of the shares. If I add debt plus market value, less cash, I get enterprise value. Basically the same story because it's market cap driven. So $23 billion of enterprise value up to $204 billion of enterprise value. What's going on here? Let's do the debt side first. So debt, early on they had leverage, they had debt because they had low earnings, but good subscription revenue. So banks are willing to lend them money, and it was kind of upside down a little bit, but kind of bumping on our ratio. This spike here is when they first issued this $1.8 billion of debt. Then it quickly came in line as earnings kind of resulted, which was nice. And then as it comes down, it's basically zero. So they're debt free. That's a great job. Enterprise value to EBITDA market multiple is coming down. It's still very high at 62 times. That's basically 62 years of for payback if there is no growth. So it's the stock is definitely pricing in growth. The question is, how much growth? We're going to cover that in here in a second. All right, so the next thing we need to do is we need to make sure cash flow is lining up with the operating income. So we're going to look at cash flow from operations, the first third of the cash flow statement. 2013, $737 million of cash flow from operations. That has grown to $4.8 billion of cash. That is a 26% annualized growth rate, which is a little less actually a lot less, about half the rate that EBITDA is growing. So EBITDA appears to be growing a little faster actually than the cash that they're showing. And I'm trying to think of why that might be. It could be the kind of share-based comp or other cash costs that they have to expend that they're currently not expending on the EBITDA line. But it is strong, it is positive, it is going in the right direction. So I'm saying that it's still very, very close. So we're going to keep going. CAPEX is the next thing you want to look at, right? So CAPEX is how much money they have to peel off and put back in the business. So at the end of the year, they generated $4.8 billion of cash that was left in the bank account after operating the business. The very first thing they have to do, put money back in for new computers, expand the production line, new office equipment, so forth. That's $700 million. that's basically giving me $4 billion of cash that's available to you and I as equity owners. And if we come over here, cash flow to equity, this is the value of the business. This is what we're buying when you buy a business. If I put it on a per share basis, it looks like this. So I've got free cash flow to equity. I've got the average shares outstanding on a per share basis. This is what it is. Right now, they're making about $4.42 per share that's out there in free cash flow. So that is a very strong number. They are issuing shares. So I think as they're making acquisitions at high premiums, they are printing shares. So this is actually dilution, kind of going the other way. We would like to see them use some of the cash that they have to either pay all cash for deals and stop using shares, or buy back shares and cancel them. Maybe they feel their shares are overpriced, and that's why they're using shares and not cash. Food for thought, but it's curious here that they are not buying back shares given the amount of cash that they have. They're also not paying all cash for deals given how much the cash they have. It's kind of curious. But moving on, I got current price as of January against the cash flow that they generate gives me a yield. And a 2% yield is a very low yield. It is a strong growth company would deserve a yield that low. Okay, now let's see what we're going to do. Before we do that, I do want to take a small time to plug my own website, cashflowinvestingpro.com, where I teach a course on how to invest in stocks. I also produce a one-pager that looks like this in the Cash Flow Investing Club, and I highly encourage you to check that out. There's a lot of other securities that I review. I produce one-pagers on that has everything that I just covered inside that one-pager for a whole host of securities outside of what I can do on this channel, but check that out. So now let's build a forecast on EBITDA. And what we know is the company's given us guidance that they're targeting about a $50 billion revenue in 2025. And what I'm going to do is I'm going to apply a standard EBITDA margin to that $50 billion and then take the growth rate down over time as I bring the business forecast forward, consistent with what they've done historically. And that looks something like this: $4 billion next year of EBITDA, and growing that over time as they continue to accelerate their, as they continue to grow their revenue and widen their margins, they get about a $20 billion target of EBITDA long term. That's 5-fold increase from where they are currently, which is a very, very robust growth forecast. There's no doubt about it. It's coming down. Growth is decelerating, right? They've done 50% annualized EBITDA growth the last 10 years. Now I'm bringing that down because they're going to get bigger. It's harder for them to grow. But that's still a big move that they have to do 5 times. And the other thing I'm going to do is I'm going to bring down the market multiple to a 20 times market multiple, which is a strong market multiple for a growth company, but it's nowhere near the 60 times that they are currently experiencing. Why? Well, because if you look at this trend is decreasing over time. As they get bigger, it's harder and harder for them to continue to grow as fast. As growth slows, market multiples come down. So I'm bringing down the market multiple to 20 times over the long term. And that basically 20 times 20 gives me about a $400 million market value, market cap for the stock. I less some debt and some cash, which I'm assuming they've dividended all the cash out. They don't have much debt on the balance. So market cap and enterprise value are roughly the same. They have 921 million shares outstanding. I divide that, and I get a price target of $446 out 10 years for Salesforce.com. Now, if I take the same methodology and apply it to the cash flow per share, the free cash flow per share, I get $5.29 growing to $18.15 out a decade. And I'm going to apply a 3.5% yield to this, which is not the 2% that they have. It's not the 4%, which it might be. It's 3.5% to give a little bit more growth. And I get a range now. I get $518, a little higher price target on a free cash flow basis for the stock. So now what do we have? We have 2 price estimates that we developed as we just looked at historical numbers, tried to string them forward, tried to be conservative, although that growth forecast is very, very strong for a long time. And what did we get? We got 2 numbers, 518 and 446. I'll average them to say 400. and $82 is roughly a long-term target for this stock out 10 years. I look in the stock market now after I've formed an opinion of the stock, and I can buy as many shares as I want right now for $266 a share. So what does this do? Well, that's growth there. Let's see how this stacks up in our IRR. So here we are, IRR. I'm going to buy the stock at $266. I'm going to get this stream of cash flow that I own. I'm going to sell it at $42. That is a 10% IRR over that period of time, which is a market return. It is not a robust return. And so making two times my money, or a 10% average return on a company with a growth forecast of this 20% every year for a decade is robust. And I think there's a lot of risk there. So for me, on this stock, as much I really do like the stock. Let's recap what we have here. Top line revenue growth, absolutely growing fast. EBITDA growth, absolutely fast. Strong free cash flow, yes, strong free cash flow. Debt is zero. Well priced. It's on the border. I'm going to give it a meh because it's producing a market return, 10%. I would like to beat the stock market. So for me, it's a pass. But I do appreciate that it is continuing to grow. It has a tremendous amount of kind of business momentum, if you will, that it should produce something similar to this. This forecast on its own, I don't know. I would like to see the price come down a little bit, keep the same forecast, then there's a little bit more cushion. For me, it's not quite there. If I put this on a distribution and I say, okay, what price would I love the stock at? Well, I'd love the stock closer to 200 a share, right? So as you get in the 15% range, for me, that's 50% more than the market return, which is great. If you take your own net worth and you just say, what do I make? What does that become if I make 15% on my money annually? For 10, 20, 30 years versus 10%. It's a big difference. And so waiting for the right time to make the investment, I think, is just as important as picking the right investment. And in this case, I'm going to wait for a better opportunity. Now, if you liked this review of Salesforce.com, I teach a course on my website, Cash Flow Investing Pro, where I give you this Excel sheet. I teach you how to read 10Ks, how to pull the material that you need out to populate this economic model. We then talk through how to build a forecast, because ultimately, if you buy the stock, you're buying the forecast you produced. So you want to make a very conservative forecast and let the price of the stock come into range so you buy it and you make what you're looking to make. That is a way to hold a portfolio of 20 to 30 stocks, super focused, but you hold them over long term and you have an understanding of the business that helps ground the investment. If you just buy a stock because the price falls and you're only buying it because of the price, if that price continues to fall, you have no faith in the investment, you're going to leave. If you understand the business, you have a thesis behind why you invested, at least then there's a little bit more to hang on to when the market takes a bath, because at some point it always does. But if you know the business, you like the product, you like the people, you're going to hold that business through the long term and hopefully realize what you put down on paper. So my name is Cameron Stewart. This is Rational Investing. Thank you very much for watching the channel. Please comment. Please hit the subscribe button. Let me know what stocks you want to see on the channel in the comments. I'll be happy to take a look. And then check out the website. I've got a course up there, and I'm doing the one-pagers for a whole host of other stocks that you can get if you join the Cash Flow Investing Pro Club. Okay, thank you very much. Take care. Bye-bye.